You actually recently changed your recession call just a few weeks ago. What led you to change your mind on your outlook?
Right. So we're now forecasting a soft landing for the U.S. economy. We still do see a material slowdown in growth from the current pace. We have it at 0.7% next year, which is pretty close to a recession, but it's not quite a recession. And a couple of things led us to change our outlook. The first one is the resilience in consumer spending. And the second is the upside surprises in business investment, along with this idea that the recessions have really rolled across the most rate-sensitive sectors of the economy, with autos being hit first, then housing, and now those rate-sensitive sectors sort of finding a bottom at this point.
Okay. So, Stephen, I want to come over to you. You believe we're in a period of economic downturn. We're just showing our wall of worry, a number of factors that are weighing on the economy. Do you see one of those clearly turning to the downside and giving us a clear sense of whether or not we're in a recession?
So all of those are issues that are now going to contribute to a deeper slowing in the economy. I would not look for a period that's going to conform to a traditional recession, sort of a collapse in everything all at once. We think that we've been going through rolling recessions and that will extend particularly to employment in the coming year. But this is not going to be a collapse in the traditional sense. We've already been growing below trend, as your other speaker just said. We've had a 21% decline in residential construction investment thus far. Manufacturing is contracted for a full year, so is trade. So it's asynchronous. We'll have slowing in the services sector, which has just been rebounding from COVID to new highs. These are things that, again, will be quite material, especially for employment. But in the end, we don't think that this is going to show up as a period of just a drastic rise in unemployment and a full year decline in GDP.
Okay, so if we don't see a decline in GDP and we don't see higher unemployment, then what makes it a recession, rolling or otherwise?
It's contractions and getting things out of the way that normally happen in recessions and just taking a longer period. It's unfortunate because many investors just would love to have a period that's clear as day, where you have a collapse like 2020, 15% unemployment, and suddenly all of your macroeconomic risks are behind you, and you can have a powerful growth year like the 6% growth year of 2021. That's definitive and clear. It's unfortunate it's not going to be that clear, but 2 years of below-trend growth, a rise in unemployment, if more gradual, all of that would be very much the same effect as having a short, shallow recession over 6 months.
All right, so Aditya, back over to you. You see a 0.7% GDP growth over the next 12 months right now. You're in the soft-ish landing camp, but you also believe that the UAW strike, student loan payments could factor in and possibly maybe even change your outlook again?
So those are downside risks to fourth quarter GDP. In terms of the student loan payments, the sooner you see the impact, the less impact you'll see going forward, right? So we see it as a relatively modest hit to GDP. Whether it happens all in one quarter or it gets dragged out over 4 quarters is still an open question. And then on the UAW strikes, mechanically, whatever effect they have on inventories gets paid back in the first quarter as well. So they do create some risk to the fourth quarter, and maybe that means that the Fed doesn't end up doing that last hike in November. But in terms of the broader economic outlook, unless you really get a protracted strike that really has knock-on effects onto other sectors, which is not our base case, unless you get that, I don't see this as a long-lasting hit to the economy.
All right, Stephen, coming over to you. Let's talk about energy prices. Oil easing off of its highs of just a couple of days ago was above $90 a barrel for WTI, but still elevated for the year. How does that play into your thesis?
Now, certainly this rebound in headline inflation, this drag on consumer incomes, all of this will contribute to a retail slowdown. And if you think about the conditions that we have right now, this inverted yield curve, tight monetary policy can leave you subject to shocks. You are in a weaker state in the event that you absorb a shock. Now, these are familiar ranges on energy. This is not like early 2022 with the invasion of Ukraine. We moved up very abruptly, and we had real question marks about the availability of supply. But this, again, does not help at this particular moment. It is, again, extending that drag on incomes. But we benefited a lot already from taking consumer income from down as much as headline inflation has, from the peak of 9% to the recent low of 3%. And that did a lot to take already recessionary consumer confidence out of that really weak position. So I think it's going to be a slowdown. It's just not going to be as abrupt unless we had another global shock.
Adi, I'm going to give you the last word. Just a few days ago, we were talking about the possibility of $100 a barrel oil. That doesn't seem as likely now, but rising oil prices, rising energy prices in general, if they continue to rise, does that change your thesis at all?
It adds yet another drag to the fourth quarter. So as Stephen said, where we are right now, it's a little bit of a drag on the consumer. I don't think it's backbreaking. You can see that in the consumer sentiment figures as well. You look at inflation expectations. They picked up a little bit, but they're fine, basically.
Okay.
They're within the ranges that we've seen. If you do get a significant further increase, though, it's really going to depend on how the rest of the consumer basket plays out in terms of inflation to see the overall impact on the consumer. But it's definitely something we're watching.
We'll have to see how it all plays out.